When it comes to investing, the first $100,000 is always the hardest. This is because you're not experienced and you don't have enough money to actually reach the point where compounding interest starts really making a difference. When you start getting gains of, 5, 8, 10%, it makes a big difference. If your gains are much higher than that, it is going to snowball. When you think of like a debt avalanche, it does the exact same thing, guys. When it comes to investing, it starts really snowballing down the hill, gets bigger and bigger and grows faster and faster. But the first 100,000, in my opinion, is a big psychological factor. So before we get into the portfolio, guys, I want to share some tips with how I'm getting there. And we are very close, guys. I cannot wait to hit that milestone. Number one being starting early. You can start this in your 20s. It's going to be it's going to be a lot easier. If you're starting with $10, $50, $100 a month, it's going to be very easy to reach that $100,000. And it's going to be faster than you expect because you do have time on your side and the time value of money and the compounding interest you can see, as well as making contributions. And always, guys, staying consistent. Getting that first 100K is very consistent. Investing small amounts every single month is definitely better than waiting for a large sum. This is how I do it with dollar cost averaging, which again in the portfolio, guys, we're going to look at in just a minute. Now, diversification is also very important when it comes to the portfolio. Personally, I do not invest anything into individual stocks. I stick with ETFs, and you'll be looking at the portfolio that I use. Now, while I'm not a financial advisor, I do have one that is actually in the same building as me that I've consulted. We've talked through it. Also, a couple other individuals that I know finances pretty well, how we came up with this ETF portfolio. And if you don't want to spend the time and effort of doing your own research, guys, definitely get professional help. Really, if you're going to have a financial advisor, make sure you do your research on that to build the investment portfolio that you're looking for. So now we're going to hop over, guys, and we're going to look at my account with M1 Finance, and I'm going to show you exactly how we have been building this. Now, overall, guys, here is the debt-free journey, which we continue. You can see the market has dipped a little bit, and we do have our investment that is going in there, $1,000 every single week. And I believe at this point, this is week 8. Guys, we are 2 months into this. You can see the current value rate here is just south of $82,000. Now that has kind of varied up and down, but overall, I want to break this down and show you exactly what I've been doing. For a majority of the time that we've been invested in this account, it has been into the VOO, which is the S&P 500. You can see over the course of 2 years, I think we're just north of 2 years, we have made almost $10,000 on a pretty small investment. I mean, 81K for some people is a very, very small investment. For some, that is a ton of money. But overall, guys, we've gained about $10,000 in 2 years. So we've made roughly $5,000 per year for the last 2 years. And again, getting to that $100,000 mark is going to be imperative. So looking down here, and I want to look at the last week because that's what we're basing this on, guys. You can see the value rate here was 82.4, went down a little bit. Friday, of course, was a little bit higher. The market rebounded a little bit. Now, I do like this. So again, looking at the value over time, we were down about 1.6, almost 2%. So we lost about $1,300 in here, which is good, guys. I like when the market is down. Now, I don't like when it's down all the time, but overall, when the market dips like this, I am not buying. I am buying more essentially with our dollar cost average that we're doing every single week, which is the way that I've built this, guys. And you can see the performance kind of down in the market, but the SCHD, the Schwab US Dividend Equity Fund, was up a little bit. So definitely carried a little bit while the rest of the market was down. Now, when we look a little bit broader, guys, year to date, so this is looking so far this year, we know we're a week in, which is where we are, but looking at 1 year. So this is actually looking at the past year. You can see, guys, our market gained is just over $10,000. But out of that, the amount that we have in these ETFs, we have gained $920. That is right, guys, almost $1,000, which is close to, I mean, what is that, like $80 a month that we got in dividends, not including the market gain that we got. So not only is the portfolio gaining, which is very cool, but we are also getting dividends out of here. And last year, our return through dollar cost averaging, putting our money in every single week, was 24% return, 23.86% return, which is kind of incredible, guys. that the market performed that well over the last year. And then of course, looking at the different slices or the pies that we have, majority of it was in the VOO. You can see we have a 22% there, but the VUG, guys, the Vanguard Growth Equity or the ETF, 67%. That is just absolutely crazy. Now, again, I was in the VUG. We got out of it for a little while, invested back into it. And now this is going to be the portfolio that we're going to do carrying forward all the way to that $100,000 mark. Now, again, looking at the beginning, guys, we actually started when we look at all was September 26th of 21. So we are about 2 years. What's that? 2 years and 3 months, 2 years and 4 months in. And you can see the ending value as of the other day was 81,000 that we put in there. So again, over $1,000 in dividends since we've started this, but money weighted return. So in 2 years, our portfolio has went up almost 40%, which is kind of crazy, guys, because again, dollar cost average makes a big difference. When you look at 2022, the market was doing incredibly poorly during that time, which means we were buying over and over and over again every week, every 2 weeks, just stocking up and building up these ETFs when the market was going down and further down, down, and down. So essentially, guys, the way that I look at this, and you really have to think about this wholeheartedly, big picture, guys, is if the stock market is declining and you continue to buy, you are buying things discounted. When you think of an item, let's say that you want to purchase for $100, all of a sudden you see that item for $85, you know you're saving that 15%, you know it is going to be a good buy. Then you see the item again a little bit later because you didn't purchase it at that 85 and you end up seeing it at 70. You purchase at $70 dollars at that point. You got 30% off, guys. That is a huge discount. Now, unfortunately, like we said with the first 100,000, it is an emotional investment for a majority of people, guys, meaning that it makes a really, really big difference when you're investing money. When you start seeing your portfolio go down, that is usually the time when people actually pull the money out, which is, again, super counterintuitive, because when it's going down, that is the time you want to be buying more. That is the time that a lot of people do kind of sideline cash at the point of buying it. But I bought when the market is up. I've also bought when the market is down, regardless of the market's ups and downs, which is what the market does, guys. If you look again, big picture, you'll see that it kind of looks like this over the past, X amount of years. The market has grown and has grown incredibly well. When you break it down into, let's say, a month, you can see kind of the ups and downs. When you get in 3 months, you kind of see the same. And then the more that you kind of pan out from the market or the S&P 500 in its entirety, you will see that the value over time has increased and it goes up very quickly. Now, the buying power, guys, we have another $1,000 right here that is already queued. We have the 3 buys. So we are continuing with the SCHD, the VUG, and the QQQM. These, again, are the 3 in the portfolio that we're going to take to 100,000. When we hit that 100,000 mark, I'm going to rebalance this portfolio because, again, we're going to have probably another 18,000 divided among the other 3 in the next 18 weeks. If we have some up market, if we do have some gains in there, we are going to be seeing those as well, guys. So looking here, the portfolio is looking amazing, in my opinion. Let me know in the comments what you guys think of it, guys. But again, looking at the all-time returns at about 40% over 2 years, to me, that is very good. And that is really the power not only of compounding interest. All the dividends are being reinvested in here, but we are also seeing a growth factor with the dollar cost averaging, which makes a really, really big difference in there, guys. All right, so that is going to do it for today's video. I love tracking the portfolio. It really puts me in touch with the dollar cost averaging and how we're kind of building this, trying to get to that $100,000 mark. And again, over the next couple of weeks, we could definitely be there, guys. All-time growth and all-time gain is going to continue to increase. All-time returns are going to continue to increase over the next couple of years as we keep this building. Once we hit that 100,000 mark, we're going to have to go ahead and reevaluate what we're going to do and what this journey is going to look like. But guys, that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.